Thanks, Peter. So I just wanted to also talk to you about the importance of setting forecasts and how we can work around variances to these forecasts, especially when we're talking to clients, self-employed clients, especially from a lending perspective. So do you have any comments you want to make around that?
Yeah, so with forecasting, we look at various aspects with clients. We look at their current business, how they've been trading, if there's some trading histories or based off what assumptions we can make, if they're just a startup business.
Yeah.
And what we do, the importance of that is it sets a clear vision and a clear goal of what they're trying to. And the banks, it's funny because most of it comes back to lending, and at a certain point in time, obviously business performance is important as well. However, what we find is that if you don't have a forecast, you really don't have a direction where you want to head in the business.
Yeah.
So it actually creates a bit of it's almost detrimental not implementing.
It's the old saying, right? Failing to plan is planning to fail.
Correct, exactly. And so having those specific areas that we look at their sales, their margins, their overheads, their fixed overheads, and it's also being mindful of any potential issues that might be arising.
Sure.
So we spoke about it earlier about short-term cash flow, but that gives you a bit of a long-term cash flow. So what we look at is it's almost a three-way forecast, and a three-way forecast is really you're looking at your profit and loss, and your balance sheet, and your cash flow. So that's what a three-way forecast is. And what that does is it drives the business direction, and it gives you a sense of the strength of your business on the balance sheet, and also the strength of your performance on a profit and loss perspective, and then there's any potential shortfall. So what we then do is we look at, we try and sit down with clients every month, or some of them quarterly, depending on the size of the business, and we look at the movements and changes in the business and what's actually happened. So if we plan for something and it doesn't eventuate or something's changed, what we do is we say, well, what's actually caused that and why is it caused?
That's where the variance part comes
in.
in.
Correct. And that's where we look at a variance analysis. And it really identifies any potential weaknesses or any potential strengths, and we try and either take advantage of the strengths or kind of rectify any issues with the weaknesses. What that does also from a lending perspective is as you continue to forecast and your variance analysis kind of gives you where things are going wrong or right, it actually performs, we found, a bit of strength when presenting those to the bank.
Yeah.
And you'd see it more than what I do. It gives the ability for the bank to say, well, if we're looking at not just the present or the past, we're looking at the future. It's also saying, well, from a lender's perspective, how strong are your financials and how strong are your variances? And the less variance we eventually, and the more accurate we can establish that
business performance,
the more we can actually start to narrow down and the more confidence we're giving to lenders.
Yeah, and you can see how that would be from a lender's perspective, how they'll show stronger. If you can show, well, the lender's going to say, why did you come and ask for $200,000? Well, this is why. In the past, we haven't needed it, or when we thought we needed it, we have been able to rectify it this way. But we can see this coming, this event, or this order, depending on the industry, or the potential to grow. So we want to go to that next level, and we've been managed so well in the past, and that just adds to the application.
Yeah,
great. Okay, so that's the importance of forecasting.